Okay, we're online right now. Hello, everybody. Welcome. This is PC here from GlobalAlphaSearch. I wanted to introduce to you today an extremely precious guest that is a very, very close person to myself and to whole Global Alpha Search, namely Dr. Robert Dieli from NoSpinForecast. Welcome, Bob. It's great to have you here.
It's a real pleasure. Thank you for having me.
Thanks. Just very quickly, Robert is the founder and the chief economist of NoSpinForecast and the founder of the macro forecasting model that we eventually use at GlobalAlphaSearch for the asset allocation process that we use. I wanted just to quickly introduce yourself maybe to our viewers. So why don't we just kick off with a short summary of what NoSpinForecast.com really is and what added value it gives to its users.
Well, I spent, prior to doing my own firm, I worked for several banks in Chicago. And we were intensely focused on the business cycle because banking is one of the most cyclical businesses that you can be in. I developed what I call Mr. Model while I was doing that work. And the objective was to give us as bankers warning as to when the business cycle turning points were going to come far enough in advance that we could do something about it. Depending on what type of loans you're involved with, or I actually work very closely with the trading floors in both the fixed income and equity sides of the trust departments, trying to anticipate where the economy would be at some point 6 to 9 months out, and to be able to then adapt strategies was what we found to be most helpful. In working with people, now that I have my own consulting firm, I have clients that run the gamut of economic activity, from people such as yourself who manage money. I work closely with all of the large trucking companies, people who make trucks, fix trucks, other capital goods producers. And for them, knowing when the business cycle might turn is very important in terms of capital spending, also in terms of whether or not to believe their order book. Funny how orders disappear when the economy softens up.
Yeah, that's
So
exactly
it can be used in a variety of ways. I have individual investors who have their own portfolios with whom I talk or who use the material. So the objective is to provide a roadmap, a guide that you can use depending on exactly what it is that you are trying to accomplish. But the one thing that is unique is that it operates on a fixed forecast horizon. It's always looking out 9 months to a year, and it is based entirely on statistics that you can get from the same sources I do. The methodology is transparent. There is no black box. So
Okay.
with that, I probably
there's no assumptions in the model. No assumptions in the model. That's very clear.
No,
right?
there are not. The only assumption is that the business cycle works. And from time to time, we've had reason to wonder whether it's going to be the case, but the business cycle does work. And that is the only underlying, if you want to call it, theoretical construct. I'm not a Keynesian. I'm not a monetarist. I'm a business cycle economist, and that's what the model is designed to do.
Exactly. So it's a macro model that is not necessarily a timing model for people doing equities or doing bonds, but it's a very helpful instrument that might give those investors or those users some kind of view on where are we really right now in the business cycle, and appropriately adjust the asset allocation of their holdings, let's say bonds, stocks, or some other holdings that they might have in their portfolio, correct?
That is true.
Okay, so why don't you just very shortly explain in short couple of sentences what enhanced aggregate model, because this is really the name of Mr. Model, right? What it really stands for. We will obviously get to the details later, but just in general, just literally 3 sentences as an introduction.
Well, in the beginning, in the mid-1980s, which is when I started to work on this, the original name of the forecasting tool was the aggregate spread. And we'll explain what that means in a moment. But then, after the 2007-2009 recession, two changes happened that required an adjustment to model inputs. One had to do with the bond market, which we'll explain later, and the other had to do with the labor market. And so when we got to version 2.0, the question was what to call the new thing, and someone suggested the enhanced aggregate spread, and that's how it got its name. I am terrible at naming things, and if someone out there has a better name for this, I'd certainly be willing to hear it.
Yeah, it's I think the name is good enough, so we can just move on, and as you said, we will just explain the details of the model in just a little second to the users. So one other question, what can the partially already answered by you, what can the enhanced aggregate spread be used for by let's say three major groups of its users? So a retail user like the average Mr. Smith, an institution like a bank or an insurance company, or an investor, an equity investor?
Well, let's take them in reverse order, starting with the equity investors. The stock market is affected by the business cycle. How and when and which stocks is the puzzle that all the equity analysts spend their days trying to solve. But if we can reduce one element of the puzzle to give them a better landmark as to where we are in the cycle, then it allows certain other decisions and analyses to proceed a little bit more smoothly. To a business owner, it comes down to what do you do and how sensitive are you to the macroeconomy in general. You get what amount to regional variations, especially in the United States, where the impact of a recession can vary greatly across the country. Certainly that's true in the global economy. As far as other institutions like banks and insurance companies, they have a typically longer horizon and also a different, I'm going to say, capital structure. Their tolerance for risk is different. And in some cases, they are seeking risk. So knowing that certain types of risk are going to be more or less prevalent can be very helpful to them from the standpoint of strategic planning. But for everyone, and I don't mean to make too much of this, knowing where we are in the cycle, I think is where you have to start. It's sort of like, if you're going to go on a trip, well, where are you? And where do you want to go? So if I want to go from Chicago to Warsaw, it depends whether or not I'm in Chicago or Warsaw, or somewhere in between. And so I think the same thing applies for the cycle. And as we'll see in some of the exhibits that I think you want to look at, the cycle length is variable, but the markers that tell you where you are not. And so knowing how to apply those measures is the first step.
Exactly. I do generally agree with you, and that's exactly why I try to introduce this at my strategy, as you really need to figure out where you are in the cycle to kind of decide what your portfolio should look right at this point in time, right? From a longer perspective, I'm not talking short-term trading, but from like proper asset allocation perspective, right? One other short question, Rob, and then we move forward. How old is the model and how much historical data does it contain? I'm asking because obviously many users of different macro models ask if there is enough data in the model to kind of judge upon the future on the basis of the historical data that we have in front of us. I know your model is relatively old. From what I know, you started out in 1988 with the model. Correct me if I'm wrong.
The first formulation that we will look at dates to there. But prior to that, I actually started studying the business cycle when I was in graduate school, which was almost before we had electric lights. I don't want to tell you how old I really am. The model, however, goes back to 1955, and we will show you a chart that I think is unique. Every forecast that the model has made can be seen on one page. And that is very different from most macro models, especially the large econometric models, which are run continuously on varying databases. And some of the variants in the databases are just revisions to the data. This is not anything nefarious. But if you run it on one set of data, you can get one set of results, you get revised data, and so forth. The numbers that are in the enhanced aggregate spread are, two of them are never revised. Those are the interest rate data. That is history.
Yeah, they're just, yeah.
The unemployment data and the inflation data are revised, but the revisions are trivial. They will change on the right side of the decimal place, usually by 1/10 of a point.
Mm-hmm.
So you're not looking at something that is a major change. So if you want to go back and look at what happened, the historical record is there.
Yeah, okay, great. So that's it as for the introduction. Now let's move on very quickly to kind of explaining how the model really works and explaining the basics of the model. We will be looking at your presentation, which is a public document, and any of your potential users can obviously use it whenever he wants. It's on your site, NoSpinForecast.com. So let's just start out with the very basic stuff. So what are the main phases of the economic cycle? I know different economists have different attitude here. What's yours in that respect?
In the fundamentals of the cycle are pretty simple. You have an expansion phase and a contraction phase. That would be the up and the down on the chart that we're looking at. Economic activity expands and contracts over time. Yeah. What I have found is that breaking the expansion phase into two segments on the way up as you approach the business cycle peaks, and then two segments as you leave the trough, is helpful from an analytical standpoint. The expansion phase is where the economy is growing, the unemployment rate is going down, inflation is calm, and it is the desired condition that we want. We all like to make our lives better, and so producing an expansion is what we do. However, we are not less than perfect at what we do, and as we approach capacity limitations, or in some cases elements of inflation, there can be any number of circumstances, we transition to what I call the boom phase, which is where elements of instability begin to appear. And usually at that point, we also are hearing from the Federal Reserve that they're getting concerned about questions as to whether the economy is overheating. After we get to the boom, we go through the contraction, first the peak, which has a set of characteristics. We then go through the contraction, which we now call a recession, to the trough, which is the end of the contraction period. We then turn into the recovery, which is where we get news that some people are starting to do better, but others have not yet started to do better. It is probably the most difficult phase of the process. Because we don't go into the recession at the same time or come out at the same time. This is particularly difficult for equity analysts because you have firms that are still suffering from the effects of the recession. You may even have some that have not yet begun to suffer from the effects of the recession. So knowing how we transition from the recession into the recovery is important. And then eventually we get back into the expansion phase, and we go around and repeat the process.
And the circle repeats, yeah. And here, where the biggest added value of the enhanced aggregate spread is by not only identifying where we are right now, but when we could see what the most important turning points, so the peak and the through of the economy. Would you agree with that?
Absolutely. And one of the things that I try to explain to people is, especially for investors, some of the best opportunities happen around the trough of the cycle, which also happens to be a period in which most people are scared, and there's usually a universal concept that, oh, this recession that was never going to happen now is never going to end. Yeah. And so getting people to understand that there are clearly identifiable indicators of when the economy is going to make a peak and a trough is very important. To give one specific example, the model called the end of the 2007-2009 recession in December of 2008. It said that the recession would be over by the summer. The stock market made its bottom in March of 2008, during the period in which the model was telling you to be looking for a stock market bottom. Now, I'm not going to say that you would have been able to time it perfectly, because no one ever does.
Yeah.
But if you had started buying stocks in March and April of 2008, you would have been doing a lot better than the people who started buying stocks in June and July or August of 2009, because the call was made late 2008. So that's one of the reasons why knowing where we are is important. And that arrow moves around the chart as we do that. And you can testify to the fact that I moved it around the chart as we went through.
Yes, I have been reading your reports for at least 5-6 years right now, and I have been through a few of those moves. So yeah, just to explain everybody that will be watching us, the current graph is not showing the current situation, which is September 2021. This was written in, I think, in 2018, if I'm not mistaken, right? But this is just for educational purposes. Yes, so let's just move on. Who defines the economic cycle phases? We're talking about the US market, obviously, because you're a US citizen and you're mostly kind of concentrate on the US market with your research, right?
Correct, but this is a little known fact. If you ask the average journalist who sets the dates of the business cycle, they'll tell you the government, and that's not true. It's the National Bureau of Economic Research, which is a private organization, and they are the ones who decide where the peaks and troughs are. This chart obviously does not include anything that has happened since May of 2018, which, as you mentioned, is when this was written. But in the report every month, there is a chart similar to this that shows where we are in the current cycle, which is at 17 months, and how it compares to other business expansions.
Exactly. Moving forward, these are just some more details about the defined recessions, right? That we have.
Yes, I don't know that we want to go into this level of soul-crushing detail right now. We want people.
Yeah, just generally, just as you do kind of count the expansion months, you do still also counts and run statistics on the
recessions,
not only the length of the recessions but the depth of the recessions as well, right?
We do,
maybe go into that later on.
That is something that is equally important, especially when. Oh goodness. I'm sorry, I forgot to turn my phone off. You can edit this out, right?
I think it's not going to be a problem.
I don't. No, but this is the length of the recessions. And again, the important part on this chart is the length of time that it takes the NBER to make the announcement. Usually the cycle turning points will have occurred anywhere between 6 months to as long as 2 years after the date, before the date that they are officially announced. And so having an indicator like the aggregate spread or the enhanced aggregate spread will give you reason, will tell you more or less where things have happened before the official announcements have made.
Exactly.
And we'll see in a moment that the forecast range of the enhanced aggregate spread includes the periods that are involved here. Sorry.
So moving on to the very kind of point right now. Let's run quickly through the enhanced aggregate spread inputs. I know obviously, but our viewers might not know that there are 4 basic inputs, and let's just go through them one by one. Right. The first one is the federal funds rate, right?
Yes, this is in the model because any model that does not take explicit count of what the Federal Reserve is doing is wasting your time. I don't mean to be overly dramatic, but any macro forecast that does not include monetary policy directly as one of its components is wasting your time. The actual movement of the economy, the things that can happen to make business cycle peaks and troughs happen, largely come back to what the Fed does and when they do it.
Exactly.
So the reason why the Fed funds rate is in the model is because you cannot forecast the business cycle without taking direct account of what the Fed is doing, and this is the easiest way to do it.
Exactly. The second input is the 10-year treasury now. So these two inputs kind of put together what most people call the yield curve, right? So that's how most of the people that don't really get into that much detail of macro forecasting pay attention to. When the yield curve is falling or flattening, there seems to be a problem around the corner. And obviously, this is the kind of a natural sign that people watch out for while looking for a business cycle peak, right? So the 10-year treasury now, please have a few words on that.
It is in the model. This was one of the changes that was made when we went from the aggregate spread to the enhanced aggregate spread. And that is because the 10-year treasury is now the flagship rate in the bond market. It used to be the long bond, whether it was the 20-year or the 30-year.
Yeah.
But for a bunch of reasons we won't go into, those are no longer used. So the 10-year treasury is to the bond market what the S&P 500 is to the stock market.
Exactly.
So if you ask a bond trader, is the market up or down, they will answer based on what the 10-year is doing.
Yeah, okay? I even read a couple of articles on CNBC over the last 48 hours, and 80% of them are referring to what happens on the 10-year treasury right now and how it impacts the market, especially the growth companies, obviously for a very obvious reason that, you know, it's kind of the price of money that people use for calculation in the DCF models.
Right. And there are basically two inputs to those models: the Fed funds rate, because that's going to determine the cost of money at the low end, and the 10-year, which is the basic pricing point as you go out the curve. The other aspect that is involved here is that the level of interest rates also, the long rates, begin to incorporate investor sentiment. And so the trend in interest rates, it tells us something important about how fixed income investors are looking at conditions now and going forward. And so the two together, as you point out, along with what they tell us about the shape of the yield curve, give us a lot of important information about where we are in the cycle.
Yeah, so your model, on one hand, involves the yield curve, as we have now described, but it's not just it. You also have two other inputs in the model, which are more stuck to the real side of the economy, right? So the first one of them is the short-term unemployment, right?
Yes, and this again was the modification that we made to the model. Every month, the Bureau of Labor Statistics reports on the total number of people who are unemployed, as well as the total number of people who are employed. They are not two sides of the same coin. They are two parts of a river that we call the civilian labor force. If you are in the labor force, you are in one of two categories. You are employed or you are unemployed. And it is possible for the number of unemployed and the number of employed to go up or down at the same time, depending on what happens to the labor force. The short-term unemployment rate measures the people who have been unemployed for less than 6 months. The Bureau of Labor Statistics divides this into several categories, but the one that matters here is short-term, which is less than 6 months, and long-term, which is more than 6 months. And during the period that followed the 2009 business cycle trough, we had a large increase in long-term unemployment that had to do with structural changes to the labor market. Those changes began to affect the timing or the reference that the aggregate spread was trying to provide as to where we were in the cycle. The aggregate spread was giving what I thought a retarded message because of the way that the unemployment component was behaving. So I moved to this measure, which is more consistent. And also, when I made the change and recast the model, the differences between the aggregate spread and the enhanced aggregate spread with these two variables was not significant as far as the history was concerned, and so we moved to that.
All right. And last but not least is the CPI, obviously, and those two we will explain that in a moment. Those two measures make the other part of your model. So yeah, CPI, inflation rate.
Well, again, as was the case with the Federal Reserve, if you're going to do macroeconomic analysis, you have to have inflation in your model. If you don't, you are, again, wasting people's time. The question is which measure of inflation. I use the CPI because it's the most widely known. There are others, and I've used them for other types of analysis. But basically, what this tells you, and as you can see on the chart, the inflation rate tends to rise as we approach a business cycle peak. One of the ways that we know
these are the moments here, yeah,
that we are possibly getting into an inflation problem is what happens on this chart. So the same way as we wanted to know what the Fed was up to, you want to know how much inflation we're dealing with, both because it will affect what the Fed does, but also more importantly, what it does for the performance of the economy as a whole.
Exactly. And now 4 inputs, putting them all together, what do we get? We get the enhanced aggregate spread, which is actually built out of 2 spreads. The one is the enhanced financial spread, so pretty much the yield curve, and the other one is the enhanced real spread, which is kind of something that is different from what most people use, which is the yield curve for judging whether there might be a cycle peak ahead of us or not, right? So maybe you can just elaborate on that a little bit.
Well, the 2 spreads are, as you see, calculated here. The enhanced financial spread is the difference between the 10-year and the funds rate. And then the real spread is the difference between the inflation rate and the unemployment rate. And as we'll see in a little bit when we look at the charts of these, how they move tells us something about the cycle, but then how they move together tells us even more about the cycle. And that is the part, when I was working on the model, that was the real piece of news to me. I had been working with the yield curve for a long time because I'd been involved with fixed income trading and helping people do that. But it was the news of these 4 variables together that give a better performance than any of the variables individually, and then even as you pair them up, as we'll see in a moment.
Yeah, exactly. So let's now kind of first try to explain how the enhanced financial spread behaves over the let's say couple of decades at least, because as you said, it's the data is, come back to 1955 from what I see, or maybe even 1954 as you mentioned, right?
All of the data, actually, I use 1956 usually in most cases, because that gives us you can start in 55, but in some cases we need rates of change, which costs us a year's worth of observations.
Exactly.
But everything goes back to at least 1956. As you can see here, the information is that the enhanced financial spread either goes below 0 or very close to 0 in front of business cycle events. The recessions on these charts are the shaded areas that you see, those bars. And obviously, this was done before the last recession, so these charts are a little bit old in the sense of they are historical data.
Yeah, but they do show kind of how the spread works, right, over time.
Absolutely, but the ones that are up to date, if we change this chart, all we would be doing is adding observations on the right side of the page. The key signal here is that when we have an inverted yield curve, meaning that the enhanced financial spread is negative, there is a very good chance that we will have a recession. There have been cases, however, where the yield curve has inverted and there has been no recession, which is one of the reasons why you don't want to use this variable by itself.
Right, exactly.
But it gives you an important piece of information. And even in the cases where the curve inverted and there was no recession, there were associated macroeconomic events. So this is always a good place to start. What is the shape of the yield curve? I will tell you the fundamental conditions in the bond market, and how and why the yield curve is where it is. You will have learned from what we saw from looking at the Fed funds chart.
So start out with the yield curve, but don't really lean on it as to kind of the real decision-making process, because that's exactly what you mentioned here. I think it's 1999 where we had this kind of situation here when the yield curve inverted, but it was still almost 3 years out until the recession really came, when the other macro data had to deteriorate substantially.
There's another one also, as you can see on the left side, in 1966.
Yeah.
I liken the enhanced aggregate spread, and you'll see why in a moment, to a pair of scissors. The financial spread and the real spread together are the two blades on a scissors. The two together are what do the cutting. Now you can take a pair of scissors apart and try and cut things with each of the blades. You can. It won't work the same as a pair of scissors,
exactly.
which is why we want to use the tool that has both blades.
Exactly. So enhanced financial spread, now enhanced real spread. That's the other part of the model. So that's calculated by deducting the short-term unemployment rate from the CPI rate.
Correct. And on this number, what is the important part is when it goes positive. Under normal circumstances, the inflation rate is less than the unemployment rate. That's the normal condition. When the inflation rate goes above the unemployment rate, this number turns positive. And when it does, we have bad news. Okay? There is only one instance, and it was in the 1960 recession, where the enhanced real spread did not turn positive. In every other case, it has. Right now, it is, which is one of the reasons why we're worried that we might be developing some instability. But we also know that we have something new right now called the after effects of the pandemic. And so figuring out exactly what we're learning from the inflation data is taking a little bit of time, but we're sort of getting ahead of things. But that's where the enhanced real spread comes from.
Okay, and now we're getting to the relation between those two spreads that you have been already mentioning. So what is the EFS and the ERS relation, and how they behave versus each other at a certain point in time, especially around the cycle peaks and cycle throughs as well?
Well, as you can see here, with the exception of 1960, every time the two series have converged, where the enhanced financial spread goes from positive to negative, and the enhanced real spread goes from negative to positive, sometime after that, and it is variable, there has been a business cycle peak. When those two series have diverged, subsequent is when we find the business cycle trough. So in both cases, what we are looking for is a process of convergence. The first involving the federal funds rate and the 10-year, and the second involving the unemployment rate and the inflation rate. And it gets you to this point. And when we look at the next chart, I'll explain why.
Yeah, exactly. That's my next question.
Why are we doing
the interpretation?
Why are we doing it with the aggregate spread? Why don't we use the chart that we just looked at? And the answer is, when this was developed, printing in color was impossibly expensive.
I can imagine that was
in the middle of the 1980s. Color printing was, forget about it. Yeah, I mean, you just didn't do it. You had to have special permission to use the color printer.
So getting two series on one chart was not doable.
Right. So the question was how to get this down to one line. And then that's when I came up with the concept of the aggregate spread, where we subtract, where you see the formula, where you take the enhanced aggregate spread is equal to the enhanced financial spread minus the enhanced real spread. And that gets you this line. Okay, so now you have one line on the page which you can print, and then you can reproduce, because now we not only print in color, we make photocopies in color. Again, back in the day, a color photocopier, there might have been one in the bank, and it was used by the marketing department. It wasn't used by the economic research department.
I imagine that. Yeah. So yeah, that's the enhanced aggregate spread that we have in just one simple line, which kind of clears out the interpretation of it, and you don't have to be kind of looking at very specific different series. You have one series of data, and how does it really work, and what does it tell us? What are the very specifics in those most important moments? So, like for instance, here and here, just ahead of the recession.
Well, I think the next chart, if you want to move ahead, I think is the better answer to your question. On the prior chart, if you want to go back for just one moment, you can see that the movement, especially if you look at the recessions that are on the right side of the chart in 1990, 2001, and 2007, it's easier to see because the movement is a little more stark. But as you can see, the movement of the enhanced aggregate spread towards zero is happening well in advance of the business cycle peak. So if you want to move to the next chart, what I did is I used, I just picked up the series that is the enhanced aggregate spread and moved it down the spreadsheet 9 months and remade the chart. And this is what happened. The recession periods are all, with one exception, in 1960, in the period where the enhanced aggregate spread is below, we'll see it in a moment, 200 basis points.
Which you call the danger zone, but we will get to this in a
we'll get to that in a moment.
So just right here, summarizing this is to say it very shortly in one sentence. What enhanced aggregate spread gives is a 9-month lead forecast that it has pretty much an 80 or 90% success score, dependent on how you interpret it, right? Because once, as you said, in 1960, there was a false negative. So the enhanced aggregate spread was not below 200 points, but there was a recession. And on the other hand, there was one false positive when the enhanced aggregate spread was below zero, but there was no recession. All the other recessions were confirmed by the enhanced aggregate spread with a 9-month lead, right?
Correct, at least a 9-month lead. In some cases, a little bit longer. The main point is that two things about this. As I said before, this is every forecast the model has made. So if we wanted to talk about, if someone was saying, well, Bob, what's your forecast record? Here it is in its entirety. Not just the last recession, not just the last two, but every recession since 1957. We know where it missed. We know why it missed. And it's all the same variables, all of the computation being the same. With the econometric models, weightings change, composition changes, so they can't show you this. I can. Some people still say, oh, well, it's not good enough. And I say, well, that's fine. It's a free country. But it has worked for me, and it has worked for a lot of my clients. It's simple, and it's reproducible. One of the things that I know, I have several former clients who I know continue to compute this chart. And I don't object. They paid me for it, and they are free to use it. And for some of your customers, they may decide to recreate the spreadsheet. The sources are public. You can get the data from the Federal Reserve and the Bureau of Labor Statistics. But the model, to me, has been reliable. And I know when I'm right, and I know when I'm wrong, and I have a pretty good chance of knowing as things are developing whether or not I have reason to be concerned and might have to look to other pieces of information to see whether or not something new has happened that the model isn't explaining. But this is it from end to end.
Yeah, and this is exactly what me personally as an long-term equity investor needs, because if I have a top-down tool that tells me with a probability of at least, let's say 80%, that something is going to come and something is going to be wrong, let's say within the range of the next 9 months, it gives me time to prepare my portfolio for what's coming, right? Whether it's something bad coming or something good coming. Right now, we just entered the expansion like 17 months ago, right? And it was time to kind of prepare your long-term portfolio to be mostly equity allocated when we should see told by the model that the recession is possibly going to come. You would possibly not want to be in equities, but rather be in long-term bonds, and maybe have a little bit of gold as well as a hedge as a value for your money, right?
Absolutely, and even within equities, there are some equities that
defensive
do well
equities,
in
yeah,
recessions.
like the utilities, exactly. Yeah.
So this is nothing that you would want to have to make panic-based decisions that suddenly all of this or all of that. Rather, knowing where you are and what your risk tolerance is, and being presented with various types of risk and when to take them is the first question that this model is designed to try to answer.
Exactly. So we know that there's a 9 months lead and very high success probability in the model. Now let's move on to how the enhanced aggregate spread is set, right? Where are we currently in the economic cycle phase, and how do we figure it out?
We can each month in the reports that I publish, there is a chart that looks like this, in which we show on the right side of the chart what the current phase forecast is. And there are a set of indicators that are used and are available to the clients to know how we determine what the color of the bars on the right side of the chart are going to be. Mm-hmm. In this particular case, because we were above 200 and because of the indications that we got from our other cycle timing devices, the forecast was that all of the forecast period would be green. In other words, that we would be getting readings associated with the expansion phase of the cycle. Currently, and not to give away the ending of this conversation, half of that is green and half of it is orange, reflecting
we'll show that later,
the boom phase, and we'll get back to that. But as a reader of the report, this is the first chart that is in the reports every month. Because
and what's important here is the 200 points level, right? Can you elaborate
Correct.
on that one a little bit? That's called the danger zone, right?
Yes, and the reason is that if we go back, and this is for the last 3 recessions, but you would also see it with this updated with the current recession, when the enhanced aggregate spread goes below 200 is when we begin to be concerned that we are moving into the boom phase. What was very annoying was that period that you see in front of the 2001 recession, where we kept bouncing around along the 200 line. Mm-hmm. We finally broke through it, and the clear signal for the 2001 recession emerged. But over that period, which also happened to correspond to the first .com boom in the stock market, we were into what at the time had become the longest economic expansion on record. There was a great deal of debate as to how long that could be sustained, and the news from the model was that we might have had a little bit of something to worry about. Turns out the important news came in 2000, when the signal broke lower, and then the stock market made its high in March of 2000 in front of the 2001 recession. So where the signal as to whether or not we might be in the danger zone is the first one that's important. And then, as you can see, the boundaries of the recessions are all inside the range where the aggregate spread was at or below 200.
Exactly. So once we know that, we know that this is the kind of first sign for us to, put on the green light in our minds and, kind of step back and think a little bit. Now, once we know that, we move on to other things that do help us see what is really happening as the time passes, right? Because you know that, for instance, the spread is below 200, and now what do you do? Start watching later. You call it the coincident indicators, and you have 3 of them, right? They help us basically figure out what is really happening with the economy during the period when we are in the danger zone. So when the enhanced aggregate spread is below 200.
Yes, and that is the second part of the process. This chart, which is usually the second chart in the presentation, shows what the model is expecting. In this case, it was expecting readings from the coincident indicators that would be consistent with the expansion phase. And what we have below are the 3 coincident indicators that basically are, we have if you look below the table, we have what we call the recession associated level. So those are the readings that they would give us if we were in a recession. As you can see on this chart, none of them are, because the aggregate spread said we should be getting non-recession readings, and so we did. And that's how we knew the model had done it right. We can get into other situations where, depending on what is going on, we may get a mixed combination of signals, which tends to happen in the boom and in the recovery phase. But in the expansion, we tend to get a chart that looks like this: green bars from the forecast, and then green numbers from the coincident indicators.
All right, so we do know that the spread is below 200. We've got the coincident indicators that we're watching as the time passes, and they help us kind of determine what really happens with the economy. And when do you really say that it is enough evidence to say that, for instance, if I have the readings of the enhanced aggregate spread below 200, and some of the coincident indicators are red, but not all of them, when do you really kind of decide that this is the time when the peak is through? Can you basically say that, I don't know, 2 of the coincident indicators need to be red and 1 can be green, or should all of them be red, or is there any rule for that?
Well, 2 things will have happened. You have to remember that as we go through the chart, we will first get a forecast of orange bars associated with the boom. And that will be when we start to get readings from the coincident indicators, some of which might already be consistent with recessions, others might not. The short rule of thumb is I usually wait until all 3 have gone into their recession indicators before I would tell people that we are at dates at which I think the NBER might call a cycle peak or a cycle trough. So what we want to do, and as I said, I think we have a chart later on, which is, let me rephrase that. This chart would have gone from green to orange to red, same way as that little chart that you see below it goes. And some of that you can see here, that progression taking place in one of the major coincident indicators that we use. This is not the only one, but this chart, I think, is a good summary. As you can see there, on the left side of the chart, you see green bars, which are associated with the expansion phase. Then those red or magenta dots at the top is the period in which the enhanced aggregate spread was below 200. As this coincident indicator moved into the various ranges that you see described below, we changed the colors on the chart. And so we went from green to orange to red and then to blue. And this would have been published every month. And we would have had indicators there to say that we were thinking that based on what we knew, what the model had told us and the indicators had told us as to where the cycle peaks and troughs might be. As it turned out, as you can see here, the business cycle peak coincided exactly with the change in the indicator from orange to red.
Orange to red, yeah.
Okay, so coming out, we were a little bit later than what the NBER actually put as the cycle trough, but they didn't tell us that for more than a year after that had happened. And we had been looking at this chart, which told us that we had gone from red to blue long before the official announcement came out.
Exactly. So right here, when the color was turning from red to blue, you could have taken, good investment decisions for the long run, because the next, as you said, the next cycle phase was not the longest in history, right? This was the time to kind of act, and you did not really need to wait for the National Bureau of Economic Research to kind of tell you that, but you had that information with very high probability from the model, judged on the 6-month average of the total private normal non-farm payroll employment.
That's correct.
Yeah. Okay, Rob. So this is this sums up how the model really works, and when and how we determine the cycle peak and the cycle through, and also how we set out where we are in the economic cycle phase with the help of the TPN-PE, as here, the 6-month average. Now, there is also in your report some other stuff that you publish, which are not maybe that detrimental to the model, but maybe you want to just say a few words about them as well in the last few charts that we would run through on this presentation.
Certainly. Go ahead.
Yeah, so the components of the enhanced aggregate spread, you show them as well, right? And then you show the graphs of how certain spreads work out throughout time.
This was designed to illustrate the point that we made about how the series converge. And so this part of the owner's manual covers just in a little bit more detail how the variables act within each spread and against each other.
Mm-hmm. Okay, so this is it. That's pretty much sums up the owner's manual. So yeah, these were the basics, and we've already passed through the time that we have planned for this meeting. But
okay.
If you have another 10 minutes, maybe Robert,
Absolutely.
we could run through to kind of show the users and the viewers the current situation and how you view it, and what's the model really saying about it. So my first question would be, where are we now in the cycle phase? And again, we would base on a presentation that you have provided to me recently. Let's start out maybe with this chart here, which shows where based on the model we are right now. So this is September 2021, and we are still in the expansion phase, but we, as we will show in a moment, we are kind of most possibly only like 4 months out in the recovery, and then, as the model shows, we might get into the boom phase, where there is a higher probability of black swan situations, and the instability in the system kind of unfolds very often, right? Only this time, the cycle is only much different than the other ones before, right? As you have already mentioned during the COVID pandemic. So the interpretation is not that easy.
The main thing to keep in mind is how far we have moved into the expansion relative to where we might be for a phase change. As recently as 3 or 4 months ago, I would have put the arrow on the other segment of the green segment that you see on the right side. But I recently moved it over here to the lower left because I think we are beginning to show some of the signs of instability that could lead to a phase change. And I have decided to call the boom the black swan season because that seems to be the people who talk about black swans pretty much talk about them in the time that we're talking about the boom. And so I don't think they're really black swans in the sense of, totally unforeseen events. They just happen to coincide with periods of economic instability.
Phase, yeah.
That they take a particular form a different time, that it could be the financial sector or the housing sector or something else, doesn't change the fact that they are evidence of instability. So that's why I put that note on the chart.
Yeah. Moving on, this is the original shape of the recession that most of the people were expecting it to be, that eventually turned out not to be right, if I'm not mistaken, because it was, rather than a W, it was more of a V to me
Well, the
eventually,
recession
at
part,
least.
yes, that is correct. This forecast, which was made in March of 2020 when things were started, did not include two things, and I frankly admit it. The first was that we would have the amount of stimulus that was applied. This is unprecedented in the United
Yeah.
States and globally. We did more this time to try and fight this recession than any other. And so the assumption that was here was that we would have more or less the standard type of response, and that what would happen in the third phase would be what we are already going through, where the supply chain problems would be enough to overcome the reaction to the pandemic. As you can see on the next chart,
Yep, here.
that is not the case. Okay, the third phase is economic growth is slower than it was as we rebounded, because we were not going to maintain the reopening pace. But the fundamental themes that you can't sell what you don't have, and then the reaction to structural change in terms of discovering the new normal, I think are very much part of the forecast. Now, whether this is going to turn into another period of economic activity that meets the criterion of a recession is still not clear, because we are still trying to work out these supply chain problems, and we may yet overcome them. But what we have certainly managed to do is convince people that this is a different process, and that how it is going to unfold over the next year is going to be different from other recoveries and other expansions.
Exactly. And right here we're showing where we are and how much into the expansion we are right now. And even though we had the news from the National Bureau of Economic Research only a few months ago, it turns out that we're already 17 months into the new cycle phase, right?
Correct.
This is the green bar.
Mm-hmm.
All right, and moving on, we just wanted to quickly show what the enhanced spread is showing and telling us right now. So
this is the updated version of that chart we looked at earlier. And as you can see, we have moved back below the 200 level. And I have put question marks on it for two reasons. The first is you see that the recession period this time was very brief. According to the NBER, they limited it exactly to the period in which the economy was constrained by the pandemic. And then,
which was 2 months, actually, right?
Basically, yes. From March, April were the 2 months that they said was the contraction. On a quarterly basis, they actually have it the peak in the fourth quarter of 2019 and the trough in the second quarter of 2021. But on a monthly basis, yes, 2 months long. You can see that it is in, again, the period in which the aggregate spread was, enhanced aggregate spread was below 200. Now, the question is, does this signal, is this a repeat of 1966, where we slowed the economy sharply without a recession, or is it something else? And that's what we are investigating in the reports that we publish every month.
Exactly. Yeah, this is pretty much the
GDP
enhanced
against the EAS. We don't have to spend much time with that now.
Yeah, let's move on then. And this is the enhanced aggregate spread. And you're saying this is new, because it is actually new that especially the enhanced real spread is so positive, right? This is something very new, actually.
Part. And the second thing is, this is the first time that we have had the enhanced real spread meet the enhanced financial spread when the enhanced financial spread is as high as it is now. If you go back on this chart and look in prior periods, by the time these things have come together, the enhanced financial spread is much closer to zero. And right now it's not. So that's the other part that's new. But yes, having this much of a pickup in the enhanced real spread this close to business cycle trough is one of the many new aspects.
Exactly. That's the EFS.
And as you can see, the Fed isn't doing anything. In prior episodes, it's after the Fed has started doing something that we need to pay more attention to this.
Mm-hmm. We're not in this phase yet.
No.
Even though the Fed has already started talking about lowering their monthly purchases from as much as $220 billion a month, they said that the possible first rate hike is still kind of far away, which is now, as long as I am aware, somewhere around the end of 2022, right? Expectations, I mean.
Well, that's what they are saying, but they have been known to change their mind with alarming speed. Let's just put it that way.
Exactly. So we need to stay focused and listen to what they say.
We need to watch them very closely.
Yeah. Don't fight the Fed, as you say, but listen to them very closely.
That's right.
What else do we have? Enhanced real spread, also pretty much new setup here after the COVID-19 situation that we had.
Well, that huge spike in the short-term unemployment rate were the people who were on temporary layoff, and that was new. That's why that number went as high as it did, and almost all of that effect has worn off. The other is that spike in inflation. To have it go as quickly as it did from effectively 0 to 5% is, again, something new and something that we are working to explain.
Exactly. It's kind of the biggest question right now for most of the investors of whether this is persistent inflation or not, right? And that's where the markets have been so wobbly lately as well. So now, just finishing it all off, I wanted to run quickly through the last part of this presentation. Here you're showing how the forecast is split between the expansion and the boom phase, right? Because the forecast is 9 months out, and from what we see here, from now on, from September 2021 up to December 2022. 21, sorry, right? Because I think there's a mistake.
That should
here.
Be December of 21. I'm
21,
sorry.
Yeah. We should still be in the expansion phase, but then the readings are saying that we will most possibly turn into the boom phase up to May 2021, because this is 9 months out from now, and this is the black swan season, and this is the instability period for the economy. So that's where the tensions are possibly going to be even yet bigger than they are right now.
Correct.
And how could this all be useful for an equity investor? Just 2 or 3 more graphs, literally, and then I'll let you go. This is the S&P 500 year-on-year change, right? So this is basically how the S&P 500 has risen or fallen versus the day from a year ago. And those 2 lines here, which are pretty crucial, the green line and the red line, if you could please elaborate on them quickly.
Okay. There are 2 points to be made here. First, you cannot forecast the stock market with the economy, and second, you cannot forecast the economy with the stock market. But you can use the 2 together to learn important things about both. From the standpoint of forecasting the economy, what matters is how the blue line interacts with the green line. When we have the green line, when we have the stock market coming through the green line from above during a period in which the enhanced aggregate spread is in the danger zone, and I think we have a chart about that in a moment. We have had business cycle peaks. Now, the red and the green lines are plus and minus 10%. And as you can see, the stock market tends, if you want to go back for 1 second, tends not to spend much time between the lines. Okay, so when it goes
once the
from
S&P
10,
enters this range of
when it goes from plus 10 to minus 10 pretty quickly, and it goes from minus 10 to plus 10 pretty quickly. So to me, those are signals as far as equity management is concerned. Typically, it goes through, it has gone through plus 10 all the way to minus 10 with only few exceptions. So anyway, the point of this chart is where the stock market is, where the business cycle is helpful. And then where the stock market is relative to plus and minus 10% can be helpful. On the next chart that I was alluding to, this is what happened in the last business cycle peak. The magenta dots that you see along the near zero are the months in which the enhanced aggregate spread was below 200, and we had known this 9 months before. So you can see on the right side, we already have green dots, or excuse me, magenta dots on this chart because of what we learned from the forecast chart. Okay. So what we're going to be looking for is how the blue line approaches the green line, what the path that it takes. As you can see on the left side of the chart, it went through 10, and then it went back over 10, and then it went back through 10 around the time of the business cycle peak. So we will be looking at this, again, from the standpoint of specific interest to the equity users, within the context of how really starting in January, because January is where we have is where the first green magenta dot appears, and to see how the blue line looks in January will probably tell us a lot both about the boom phase and about what the stock market is up to.
Exactly. So once January starts, what we would need to be looking out for is this kind of setup where we have the magenta line here. So the enhanced aggregate spread is below 200, and we have the S&P approaching the green line, which is basically a 10% move from the same period last year, right?
Correct.
So once this kind of goes down through that level, there is a very high probability that we are facing a bigger event, and then the move in the equity markets can be pretty quick, going through from plus 10 versus last year to even minus 10 versus last year, which is actually an over 20% move. Last chart, Rob.
This chart allows you to convert the daily price to the position related to the prior chart. Each of the green line on this chart, these are the daily close of the S&P 500, and the red, green, and black lines are, the black line is the level of last year, same day, same trading day, not same calendar day.
So 250 days, right, for a year.
Well, it is. I do this on a trading day basis because the calendar varies. Holidays happen at different times. So this puts you trading day to trading day. And this allows you to see where the line on the prior chart will be. Because if all of these dots are above 10%, then the prior is a monthly average. You will know that we are still above the level that we have to be concerned about. Now, the point that I want to make with this chart is that at the beginning of 2022, the blue line here is going to turn into the black line on the chart. And so we will be looking at levels in which we will be comparing
much higher levels.
The stock market in 22 against the stock market in 21. And this is going to change this configuration considerably. So the idea that we can stay above the 10% level for the rest of this year, I think is a pretty good bet. Because as you can see, the green line, I think the top of that is just slightly north of 4,000. But we will open next year at essentially that level. If you go over to the left side of the chart, I think we were, well, not at 4,000, we were probably about 3,700. So we will be comparing the 22 numbers to the blue line on this chart, which means that by this time next year, we have to be with an S&P that's above 5,000 to stay, well above that level. And so that is one of the things that, again, from an equity standpoint, thinking about where we are in the cycle and what conditions we would need to meet to continue to maintain what I would call expansion type readings, this gives you some targets against which to base your analysis.
So the economy is in relatively good shape. The forecasts are up like 4% for next year, I think. The EPS are doing okay on an aggregate basis, let's say, for the S&P 500, but we need to watch out starting the next year because from the very macro point of view, there are some reasons to think that there might be some bigger instability. Should it come from the inflation being more persistent that everybody expects, or any other source? This is going to be the time to be more careful about how we invest and in what assets, especially more the risky assets, right?
Agreed.
Okay, that's it for the presentation. Rob, thank you very, very much. It was great talking to you. It should have been a 45 minutes meeting. It's now an hour and 10 minutes. So I'm sorry for keeping you so long.
It's my pleasure.
We had a few other topics to talk through, but maybe we do it during another meeting later on.
Anytime you'd like to do it, just let me know.
And then we could concentrate more maybe on the equity markets as we planned this year. But this would be it for now. It was great having you, Rob. I hope it will convince some of the investors and our viewers to purchase your precious work, and they can do it on the NoSpinForecast.com site. And obviously, I do promote your site on my site, GlobalAlphaSearch.com as well. So whenever you want, just feel free to come over there as well. So thank you very much, Rob.
Okay. My pleasure. We'll talk again.